Three types of accounts: taxable, tax deferred, tax free. We already talked about the taxable account. Let's talk about number 2, tax deferred. So I want you to think here pre-tax or traditional. We're going to look at IRA specifically, but these all apply to traditional 401ks or traditional 403bs, 457s if you're in state and local government, TSPs for those in uniform or federal government. So what are the rules? Let's talk through those. So who can open an account like this, an IRA account? Those would be individuals that have earned income, meaning they have a paycheck or they're self-employed. They have income that they're earning each year. So you have to have that. There's no longer an age limit. So you can be a child, you could be a retiree. There's no age limit on opening these accounts. So because they're retirement focused, there's a limit on how much you can put in. So currently for the government, for putting in an IRA, they limit that for years 20 and 2021 to $6,000 per year per individual. And those over age 50 can put in an additional amount called a catch-up of $1,000. For IRAs and 401ks, there's different amounts and those change each year too. Currently it's $19,500 plus $6,500 for those over age 50. So the difference here between the taxable account, which we talked about last time, is now around this account, around that box that I'm depicting as an account, we have this protection. An IRA account, a pre-tax account, a 401k, they all act the same. It provides protection. So you put money in, you deposit, you make contributions, payroll deferrals. The amount in the account can grow because it's invested. However, because it's in that protection, there's no tax. It's tax deferred, meaning it's going to happen later in the future when you take the money out. So you are limited in how much you can put in. Inside the account, it can grow. You're not taxed then. You're taxed later when you take the money out. And it depends on what age you are when that happens, the rules that you would follow. So if you touch your IRA account, your 401k, your retirement account before 59 and a half, the government's going to add an additional 10% penalty. But if you wait until you're old enough, meaning after 59 and a half, you can take that out. It will then be taxable. And the thought here is when you put the money in, you got a benefit. They allowed it to wait and bake. When you take the money out, that's when it's taxed. And it's really the government just collecting their tax revenue. There are some additional rules on these pre-tax accounts is you're required to start taking money out. So required minimum distributions, RMDs. There was a recent change called the Secure Act, which pushed that back from age 70 and a half to 72. So for those that turned 70 and a half prior to 2020, you have to keep taking your distributions. If you haven't turned 72 yet, that's the new RMD requirement age. So we'll have more videos on that. Always feel free to reach out to us if you have questions. But that's how these accounts work. It's a great account if you want to have some tax benefit on the front end, let it grow, and then later on in retirement ages, maybe in lower brackets, start taking money out. A lot here, we're just giving you the high levels. Please feel free to reach out if you have any questions. We're happy to help you.